Thank you for joining us. It's a great pleasure to have with us today Rupal, Bhansali, Chief Investment Officer of International Equities at Ariel Investments. Rupal, it's a pleasure to have you on the program. Welcome.
Thank you. Glad to be here.
Well, we're really excited to learn from you about global value investing. A lot of experience from different angles, and it'd be interesting to hear, first of all, how you got interested in investing and what really motivated you to go down the road of becoming a global value investor.
Well, I was born into a family of brokers and bankers, so I think it's partly in my DNA. I grew up, learning accounting at a very young age. In school, I did double entry bookkeeping. Finance always fascinated me. So my very first internship when I was going to college, I actually skipped a lot of classes. I was never into academics, and I started working at age 16. So my first job was actually as an intern on the foreign exchange desk. And that's when I got exposed to global equity investing, from that vantage point. Then I worked on Dalal Street, which is the Indian version of Wall Street. And I realized that, investing is best practiced in a more capitalist society. So I decided to come to the US, and I made, my mission in life to sort of learn the art of investing, because I think the techniques of investing can be learned in perhaps an MBA in finance program or a CFA. But really investing, as I learned over the years, it's more of a craft. It has to be practiced. It has to be learned. It cannot be taught. So I think in America, the vantage point of being able to learn from the gurus like Benjamin Graham about margin of safety, or Warren Buffett about quality investing, or Phil Fisher, who wrote a book, and I thought it was an excellent book to explain growth investing, because a lot of people talk about value investing, and I wanted to understand, all facets of investing, because you need to test out in your early years whether this is right for you. And I must confess, of all the things that I read, got myself exposed to, I thought Warren Buffett was the most influential person in terms of teaching me how to think about investing for the long term. But also my very first job on the buy side was at Soros, which is an unusual thing to happen for a long-only manager, which is what I am today, because that is a long, short career. And that taught me how to think about risk management. And I think very few long-only managers get that kind of experience, which I was blessed to have. Stan Druckenmiller and George Soros were extremely good. And I got mentored in this notion of how to think about downside protection and risk management. So I think all of those things sort of have played a role in the investment style that I sort of now practice and have practiced for the last 2 decades.
Well, we're so excited that you will share some of your insights with our audience, and we look forward to learning from you.
My pleasure.
Now, being contrarian is one of the key elements of Ariel's investment philosophy. And I'm curious how that mindset is reflected in your approach to idea generation and selection.
Sure. You clearly hit upon a key theme. We like to think of ourselves as independent thinkers, but in this environment where a lot of people tend to act as lemmings in the market, it makes us contrarian. But the way to, the reason and the way in which we approach investing, which is quite different from many others out there, is that many investors start their investment process with screening. And in their screening process, they screen in ideas that fit. Our approach is the opposite. We screen out ideas. We sort of say, let's reject. We don't accept. Psychologically, that creates a notion of the idea must compete for our attention. Because we tell the idea, well, you don't quite stack up. You're not good enough for us. Now tell us why you are. So I think from the very get-go in our investment approach, we are trying to eliminate rather than select. So that's the beginning. Then what we try to do is we understand that in investing today, the battleground is no longer having access to information. That was yesteryear's investing. Today's investing in 21st century is about asking the right question. So you're no longer going to be a good database, you're going to be a good search engine. The answers are there to be found. It's the right questions to ask. So that's how we differentiate ourselves as well. We're not looking for information, we're looking for insights. And the third way in which we differentiate ourselves, and it manifests itself in the idea generation, is we always ask the question, not just what can go right, but what can go wrong. And this is where the notion of what can go right is the way Buffett would think about, the quality of the investment proposition, the franchise, the moat, the prospects, as Phil Fisher would talk about, the growth prospects, the compounding in the business. So that's what can go right in the business. But then you ask the question which a Benjamin Graham would ask, which perhaps Sir John Templeton would ask, what can go wrong, and is there a margin of safety in what I'm paying in the business or what I'm being asked to pay in the business? And when you tie the two together, so our approach to investing is not just looking at the returns of the business, but also looking at the risk of the business, and where is the intersection point of where the good risk-adjusted returns would be, is what price do you pay for that so that you're being paid to take the risks. So I think that's how we tie in where we are different, how we are independent in our thinking, and how we are contrarian in our idea generation. So I can give you some examples of the kinds of ideas it has led us to, but that's the approach.
And we'll get to the examples
Sure.
a bit later on. I really want to just stay with the conceptual framework here a little bit and delve deeper here to understand when you state that you seek to own undervalued quality franchises. A lot of people will, let's say that. Ultimately, few people will say, I'm not looking for those, or would rather look for something else. So I just want to get at what are some of the reasons that quality franchise businesses become mispriced, and how do you go about gaining that comfort that they're actually undervalued?
Sure. Two-part question, so I'll answer it in two parts as well. I think you're absolutely right. We look for undervalued quality franchises. The interesting thing about our investment profession is that it's not just an intellectual sport, which is to try to identify what is a business, what is the fundamental intrinsic value, etc. Increasingly, it has become a psychological sport. It's a mind game. There are too many investors out there who want to make money quickly. And so I think the opportunity for long-term value investors like myself present themselves because we understand that psychological behaviors in the marketplace cause people to take actions which are contrary to what the right mode of behavior might be. So I would say examples of that is, for example, last year, there was a fetish for emerging markets. And everybody wanted to put more and more money. You saw the fund flows go in that direction. And nobody wanted to put money in the submerging market of Japan. Well, we've perceived to be a big value spread differential where Japan, for the first time in, I would say, about 25 years, became cheaper than even the US market. And so I think finally that correction, which had many, many false starts before, we thought presented an opportunity. And the first time in my career that I became overweight Japanese equities in my portfolios. But that's the point about, where you can take advantage. People's attention might be steered in the wrong area because that's what everybody's talking about in the popular press. So by being contrarian, again going back to the original theme of being independent thinkers, we sort of perceived that there was an opportunity on that which was absolutely out of favor. Nobody wanted to invest in Japan. And we thought there were some fantastic opportunities such as, Toyota, which is a terrific multinational company with global growth prospects, Denso, which is an auto component supplier, Murata, which is a play on smartphones, and therefore you could participate in, say, the growth of Apple, but Samsung as well, because they provide, the backbone infrastructure that goes into these sorts of new age devices, I would say, tablets, etc. So there is an opportunity to own some of the best businesses. Our job, and this goes back to, how do you find them, is to cast the net wide. So the vantage point that we have, because we manage international equities and global equities, we can go anywhere in the world. And somewhere, sometimes, there is always markets or sectors or stocks that someone does not want to invest in because in the near term, in the foreseeable future, they don't look attractive. So combining this notion of being contrarian and being long-term allows us to find these mispriced opportunities and avail of them before the rest of the market cottons onto them. I would tell you of late, given how much the Japanese market now has performed, I would say that opportunity set has reduced substantially. So that's why, again, active management is helpful because we were able to avail of that opportunity in real time, to our investors' benefit. So I think that's the two-piece answer, which is there are undervalued franchises, but they may not all be in the same place. So you need to look far and wide, and we do in the global equity mandate that we have. And second, you need to be psychologically prepared to own things that nobody else wants to own And I've always told my investors, I prefer to look dumb than be dumb. So often by owning some of these markets, you don't look very smart at the time, but eventually you do very smart things in the client's portfolios. So that's what it takes.
And I guess related to the example of Japan in particular, it's interesting to note that perhaps the global media were not at all interested in Japan.
Absolutely.
Back when you thought that the opportunity set was quite extensive, and now that the market has rallied, you're saying that the opportunity set is actually changing.
Absolutely.
But the media seems to be now, you hear more and more about Japan and it's being printed. So is that then the essence of being contrarian in a way, being lonely?
Well, it's not only being lonely, although that's a big part of it. It's about being right. So it's not about sort of being thoughtless and mindless about where you put your chips to play. But I will say this, that generally speaking, you're correct. If there's a lot of media attention on something, if there's a lot of investor fund flows into something, if it becomes what I think of just in common sense lingo, a crowded trade, I think the sophisticated investor, the long-term investor, would be well advised to stay away from the crowded trade and to go where the lonely trade is, where you won't find company today, but that's why they become mispriced. If there's one thing that people need to understand about investing, is that you need to find something that is mispriced. That's the crux of investing. The business does not change, but the price at which that business is available is changing all the time in the marketplace. And that's what our job is. We, day in and day out, we are researching the quality of the businesses. And they don't become available to us at the price that we want them to at the time that we're researching them necessarily. But we're not impatient. We do the homework, we do the research well in advance. I've been researching Japanese equities for 20 years. It's the first time I became overweight. But the cumulative knowledge and experience and know-how that you build is very useful so that you can jump in with both feet when everybody else is exiting. You can enter that battleground and do it with conviction. Do it with confidence, do it in size. And I think all the cumulative experience. So it's not about sort of suddenly saying, oh, Japan has gotten out of favor, because by that time you need to have done your homework. Well, which are the kinds of investments that you want to partake of when the opportunity presents itself? So I think it's both. It's being contrarian in the sense being psychologically prepared to do things which may not appear to be the right thing to do at the time, but also intellectually have done the homework on what are the kinds of businesses that truly represent value as opposed to a value trap.
And just thinking about then on a global scale, just to take some more practical examples into it, Japan, or where perhaps, let's say, one could be easily contrarian, places like Russia or Argentina, but perhaps we can tie that into then this important aspect of risk management that you talk about. So it's not just about being different and being right. Contrarian. And in that context, could you talk a little bit about risk management versus return management? And you emphasize always the importance of risk management. So help us understand that in relation to these perhaps obvious contrarian plays and why you don't jump into everything just to be different.
Exactly. I think that's the key. It's not about being different, it's about being right. And the only difference often tends to be for value investors is that we are early. So it's more about the timing of it. We tend to see things ahead of when other people see them. But that's what presents that mispricing opportunities for us to avail. To go back to your question about, no, we don't like to invest in Russia. In fact, we've done a lot of research on it and we've concluded that the risk of investing there is very high. Now, how do we do that? How do we make those assessments? I think the definition of risk is very important. We define risk as losing money. That is plain and simple the way we think investors ought to think about risk. It's the risk of losing money permanently. If you lose money temporarily, you should not be afraid. Because that volatility of losing money temporarily is actually an opportunity for long-term investors because it allows you to average down. If stocks never fell, you would never average down. If they kept going up, you're averaging up. That's not a great bargain. It's the opposite. So I would tell you that the advantage of doing that homework that I talked about is when we are researching and we tie in this notion of risk management and return management is we ask the question, what can go wrong? And I can tell you many things that can go wrong in Russia, just to pick on that example. The corporate governance. After all, when you invest in equities, you are delegating the task of running the business to a management team. You want to make sure that that management team is running the business in the interest of the minority shareholders, because that's who we are in any of these investment opportunities. And generally we find that the Russian corporates tend not to do that very well on our behalf. Second, if we find that the regulatory regime in that country is so fluid that it's really impossible to make an assessment of the kinds of risks we are exposed to, well, that's infinite risk. We can't even quantify it. So then we don't know whether we are being paid to take that risk. So the moment we come across what I call something that's binary, we walk away from it. Saying no is very important in investing. I talked to you about how our screening process starts with the premise of we want to say no to an investment idea, not yes. And it's only when the investment idea is so good and it speaks to us as being so good that we say, gee, we can't say no to this, we ought to say yes to this. So that's how it comes about in terms of risk management. That is the idea so uncompelling and so risky that we can't even quantify the risk, we'll walk away from it.
And could you perhaps then, in that context, give us a sense of where people can make mistakes in that equation? One is, let's say, the quality of the business and management and making judgments about that, and then this elusive judgment about the mispricing, setting price in relation to what you're getting, as Warren Buffett says, value. How do you really make those types of judgments? It's so elusive, in particular then with this laser focus on risk management.
Well, that's the hardest part, and that's why we believe that investing should be practiced by professionals, because it is a professional occupation. It's a full-time job where you have to make these sorts of calls, which require judgment, and judgment, in my opinion, is nothing but the cumulative experience married to some skills and knowledge and information that you pick up along the way. And I think that, therefore, people who believe that an academic degree is going to help them become a better investor, or just being well informed, on a given day by reading a magazine or by listening to an interview, that's not enough. It may be a good start, but that's not enough. What really it takes to invest is you need to surround yourself to understand the business from the inside out, not from the outside in. And that means a deep domain knowledge of what drives that particular business. So when we did research on, say, Toyota. Now, Toyota is a company that you think is so well researched. Where is the information advantage to be procured in researching a company like that? Well, guess what? A lot of people misunderstood what was going wrong at Toyota, including Toyota itself. But the job of Toyota's management, when there was a management change, was to figure out, to take advantage of the crisis. Toyota had faced many problems, including some of the quality issues in their components and some acceleration of brakes, etc., which they were exonerated on. They were never at fault, but they took, and the downturn in the auto industry, etc., worldwide, they took advantage of that to reset the business on the right path. In particular, one of the things that few people talk about in Toyota is that the CEO of Toyota, who is the grandson of the founder, but of a very different type, he is a big believer and actually is a professional test car driver, race car driver. So he actually tests every new model to see what is the feel of the drive. Before that, Toyota was all about durability, reliability, factual metrics, but not the soul of the car, where the German engineers, where the German designers, the Italians, with the Lamborghinis and the BMWs, was sort of stealing a silent march. And the consumers were evolving in that direction, where the look and feel of a product was as important as the functionality of the product, as we know with some of the devices we use today in technology. And I think Toyota understood that. Now, that kind of an insight you only get, and we actually researched and found a lot of interviews with the CEO. Very few people go around looking for, what has the CEO said, because not too many people get an audience with him, and neither did we. But by hearing how he was trying to get Toyota from where it was to where it needed to be, a lot of people talk about the cost cutting at Toyota, how they were going to relocate some factories and how the yen was hurting them. Well, that is information that everybody had. What we had was an understanding of how they're going to pivot the company to position it for the next decade or two both in emerging markets where they needed a value engineered car, but in developed markets where they needed a car to move more upscale. So then they relaunched their hybrid technology. Now this company always had strengths, but how you apply your strengths is more important than just having them. And I think this is the kind of surrounding of the research where we are trying to find out, what is different about how we understand this company's positioning, where we understood that by introducing this new technology, they would be able to differentiate themselves from the conventional view that Hyundai, which was coming in at the low end, would be able to steal a march on Toyota. We were able to rule out that threat because Toyota was moving more and more upscale in terms of the technology deployment in the cars. And Hyundai would not be able to catch up because to invest in hybrid technology takes decades, not just years. So this is the kind of investment research that I think an investor has to do, and we certainly do it on all different companies. Then we would talk to the suppliers of the company. Then we talk to the competitors. We try to understand at 360 degrees on that company before we even get to what I call the financial model of the company. Everything I've talked to you about right now is the business model of the company. What drives the business. Then we look at what are the numbers behind that business. Too many people start with the numbers first. Numbers are telling you, what's history. They're not going to be telling you what's going to happen in the future. The future is a business strategy. That's where we start. Then having looked at the business strategy, we say, do the numbers make sense in the context of what we understand about the business? And then finally, even after we've done these two things, business model, financial model, we then look at the valuation model. What is the market telling us about the risks that this company is exposed to? What is the market telling us it's going to pay us to absorb those risks? And when Toyota's stock price fell 60-70%, when everybody was concerned over the risk of it losing market share, of the yen causing it to lose its margins, of it losing market share, the threat of new competition, it was paying us for all those risks. And I think that is the key to investing. Knowing what risks you're taking, but also checking whether you're paid to take those risks. Once you have those two things figured out, investing actually becomes fairly straightforward.
And it's a great example, and as you were talking, I was thinking about the various sources of edge in investing, and with Toyota, as you said, everybody had the same information. You applied that analytical aspect to the opportunity, but perhaps most important of all, that behavioral edge that we talked about earlier, where it was contrarian, nobody else was really looking at it. So I'm curious, with your global experience and how you look for mispricings all over the world, do you actually find the various sources of investment edge present to various degrees in different markets? Sometimes people say, well, the US is such a mature market, or I guess Japan, that certain types of edge are more important than others. What is your take on that?
I think an edge can be developed by having a circle of competence. All we have done is go beyond what I think many investors do, which is they tend to have a narrow circle of competence. We've extended it so that we have a global circle of competence, as I keep pointing out. And also we've ensured that we don't have biases against any sector. So we don't say, oh, we'll never invest in autos, or we'll never invest in airlines, or, we'll never do technology because that's not a value investment. We believe we owe it to our investors to figure out where is value being created for consumers and hopefully eventually for shareholders. Because if you create value in your business, if you are solving a problem that either a patient has or a consumer has, well, that consumer or patient is going to pay you for solving that problem. And we just want to know what we have to pay to avail of that opportunity set. So I would give you an example where, last year, for example, people thought that Apple was a great investment proposition. We went on record saying that Apple is overvalued in the sense of not that the return prospects don't exist. Clearly, if they launch more products and more hit products, that clearly was going to come their way. But there was a very big risk that they would not have a successful next generation launch, that actually competition would increase and they would not be able to charge the same premium pricing that they had vis-a-vis the alternatives. And we also thought that the risk of them actually missing out on some of their earnings forecast had increased tremendously. None of those risks were priced into the stock. So it's not that we don't believe in the success of the business of Apple, but as an investment opportunity, we were not being paid for some of these risks. So now that the stock is corrected, it does not surprise us because some of those risks have manifested themselves. So that's one example of how it's not just about contrarian thinking, but it's understanding what is priced into the stock and therefore what the consensus expectations are. And to the extent you feel the consensus is wrong, well, definitionally, you're contrarian. But that's an outcome of understanding what the consensus is thinking and pricing in. I don't know if that fully answers your question, but I think at the core of investing is understanding both things. Too many investors focus on, gee, is this a good business? Without asking, what am I being asked to pay for that business? And also they fail to ask, what can go wrong in the business, and I'm being paid to take the risks of what can go wrong. And that's the kind of holistic 360 degrees research that a professional investor would do on behalf of the naive investor, if I may call them such, because that's our profession. We do this day in and day out, and we come across information that the average person may not come across because they're not looking for it. In our investing, we look for things that can go wrong. People generally don't have the stomach to do that because they're already going in thinking, I want to own this, I want to look for reasons to own it, not for reasons to not own it. I again go back to the way we started out, is we look for reasons to not own, to reject, to eliminate.
And there are many aspects to this, and I'm curious for the investors out there, what do you then think is the single biggest mistake that investors make?
Well, I'll answer it in two parts because, the current single biggest mistake people are making is they're confusing short-term volatility as risk. And short-term volatility is not risk. Long-term loss of capital is what is risk. And so today there is a definition of risk that is favoring stability and certainty. Fixed income investing. People just want to be in the safety of US treasuries or some equivalent thereof, municipal bonds, etc. And I think it's a misnomer to think that there is no risk simply because they're perceived to be stable investments. On the other hand, because equities are perceived to be volatile and there's a lot of uncertainty in the markets, people think that that's a risky investment. I think the biggest mistake people are making is thinking about risk as an absolute. Risks exist all the time. The only question with respect to good investing is, are you paid to take that risk? Today in fixed income, you're not paid for inflation risk, credit risk, duration risk, all sorts of risks. But people don't care because they don't define risk in those terms. On the other hand, in investing in equities, yes, there is uncertainty. Yes, there is short-term volatility, but you're being paid for that. So I would say that that's the biggest mistake investors make. The definition of risk is wrong. Risk is not short-term volatility. Short-term volatility is an opportunity, not a source of risk. It's actually a source of return. And second, to think that bonds are a safe investment and equities are an unsafe investment is to forget that valuations are what makes something safe or unsafe. And we think bonds are very expensive, and that means they're very risky. And to the extent that equities, the bottom-up equities that we are able to find, we don't comment on any asset class as a whole, we think that are actually paying you for the risks that they expose you to, so they are less risky.
And one often hears out in the street this, why should I invest in equities? And I guess that is sort of a great answer there, or is there anything else that you think really is necessary for people to understand why they should invest in equities?
So I'm going to give you a philosophical answer to this one, because I think if I tell you that it's a great time to invest or a great asset class to invest, it'll sound self-serving. But I think this is why the person on the street should invest in equities. This is why I invest in equities. This is why I chose the profession, frankly. I think if you believe that mankind will progress, and you've seen the progress mankind has made over centuries, equities is a warrant on mankind's progress. That's why you invest in equities. Bonds don't give that to you. Equities give that to you. Apple, Google, all the success stories which are human beings having come together in a corporate structure and having listed themselves, that warrant on the progress of mankind is only available through equity investing. Does it come with certain short-term volatility? Does everybody succeed? Of course not. But it's like nature. Nature also succeeds by trial and error. So we have a lot of failure. We have a lot of experimentation in the equity markets. People have to accept that. That's how nature made us better as human species. In investing, the same principle applies. What we do for our investors is figure out, what is the error part and where is the trial part, and we try to then restrict ourselves more to the proven part and the less error-prone part. So by improving the odds of our selection, we're able to deliver superior risk-adjusted returns. So I think that's the way you want to think about investing. It's your way to participate in the progress that we all will make as a species.
And certainly that progress, that optimism is perhaps most expressed in so-called emerging markets. And I'm thinking China, India, Brazil. But often then it's there that equity investors assume a lot, and in a way the promise and the optimism that was there in a way is justified by the fundamentals, but as equity investors you don't necessarily make a good return. So my question then to you is, perhaps that optimism as an equity investor would lead you to places such as India, China, emerging markets. Give us a sense where you see the biggest inefficiencies in global markets today. And when I look at your portfolio, you do have exposure, as we talked about, in Japan, as well as in some emerging markets. But I'd be curious to hear from you about where you see the biggest inefficiencies.
All right. So when I said that equities are a way to play mankind's progress, the definition of progress is not growth, although many people view it as such. The definition of progress is productivity improvements. Can we do more with less, right? Are we spending our time more effectively? Does it take less time for us to make something than it did before? So if you think about, in that sense, mankind's progress, the biggest bang for your buck in terms of productivity has actually come in the developed world, not necessarily in the emerging world. The emerging world has achieved growth by increasing the population that they have, not necessarily by making that particular population more productive. So I think I just want to reset. The notion of progress is not to be determined just by growth. It's more to be determined by standard of living and by productivity improvements. The second thing I would point out is that, yes, there are lots of people who think that the best growth prospects are in India and China, etc. But again, as I talked about investing, you're not investing in isolation of valuations. The business prospects of businesses there may be good, but if you have to pay for it, well, that does not make for a good investment opportunity. And I think in the last decade, because these markets have performed as well as they have, and I'll throw in Brazil there and many other countries of that ilk, I think that the value spread has actually deteriorated quite a bit in favor of, I would argue, the developed markets. So while I don't have any systematic biases towards emerging markets, against emerging markets, generally speaking, when something becomes a crowded trade, and I think after a decade of that asset class having come into vogue and favor, look, I cut my teeth in emerging markets in the 90s. And at that time, nobody wanted to invest in international equities. Nobody wanted to invest in emerging markets because, the LATAM devaluations, the Russian crises, emerging markets were crisis prone. And actually, it turns out that it's only after a series of crises that they built up their infrastructure and the institutions, and they got so cheap, most importantly, that they formed a base from which to increase in value. I think that increases occurred. So the next iteration of it, I don't think will be as rewarding, because the base effect from where you're starting, the baseline, is a lot higher than when you started out at the start of the decade. So I would suggest to people that whenever they find the media and a lot of people talking about an investment opportunity that seems slam dunk and very seductive reasoning, by that time, that opportunity has passed you by. It's the stuff that nobody talks about, the stuff that nobody's looking at, which is likely to be that lonely trade, which is mispriced and undervalued. Now, investors, without practicing this as a profession, would find it very hard to come across that. So I would say the best thing an investor can do is to find the right person to make those investment decisions on their behalf. And in that construct, I think the principle that they should keep in mind is investing is a marathon, not a sprint. It's more about stamina than about speed. And that's how we, with the turtle logo, as you know, slow and steady wins the race. So I think investors should think about making investment decisions in that vein. They're constantly looking at a scorecard that is daily, weekly, quarterly performance. And the people who win a sprint are not necessarily the people who win the marathon. Because in the marathon, you need to pace yourself. If you actually run too fast in the early innings, the chances are you're actually going to do quite poorly in the marathon. So I think it's a reset of how they think about the decision they need to make. Once they understand that investing is about finding the right kind of investor, they should then delegate that investment decision to those people and not question them in the intermediate period. Imagine if you were a gourmet cook and you were cooking something up, and the person who was going to consume that meal, sort of 5 minutes after starting the prep of the meal, said, let me taste something. Well, it's going to taste awful. 10 minutes after the meal, let me taste something. It's going to taste awful. And you will think this is an awful chef. Well, you've not allowed the chef to practice their craft. And I think that's what I think investors should really keep in mind. Investing takes about 5 to 10 years. So the only decision left to you, because it's going to be a long time that the money is going to be managed by someone else, find that right investment manager for you.
And perhaps one practical expression of that is in Europe these days, where we see a lot of people just struggling how to make sense of the crisis. Investors eschew uncertainty and get paralyzed by it. So
that's right.
Could you explain to us how you look at, and I know you don't look necessarily at countries or markets, but
that's right.
From your bottom-up research, how have you focused your investing analysis to finding the right mispricings in Europe, let's say, which may be contrarian or not, but walk us through Europe.
All right. So I'll give you an example of, not just within Europe, but all over the world. There was a great deal of uncertainty with respect to a sector called healthcare. And healthcare, is facing austerity cuts in Europe, but it's also facing sort of reimbursement pressures under Medicare and Mediclaim, etc. That whole sector is facing patent cliffs, expirations. I mean, everything that can go wrong is going wrong for that sector, right? From pricing pressure to competition to sort of productivity, R&D productivity problem, etc. In the midst of that, in Europe, where everybody wanted to therefore buy consumer staples, because that was a defensive way to overcome this uncertainty. In fact, you're not being paid for uncertainty in consumer staples. They're quite richly valued in my view. In healthcare, that uncertainty is priced in and then some. 2 investment opportunities that we came across last year, which has really, to give you an example, Roche, which is a Swiss healthcare company, predominantly more biotech than conventional pharma, and they focus on therapeutic categories which are life survival oriented as opposed to lifestyle oriented. Cancer, oncology being one example of that. This is a company where, because people were so concerned about healthcare, they threw the babies out with the bathwater. And Roche didn't face the same patent expiration cliffs. They did not face the same pricing pressure, reimbursement issues. Not as much, clearly some. And here was a stock that you could buy on 10 times earnings and a 4.5% Swiss franc dividend yield. And nobody wanted to own it. And this is in Europe. Another example, GlaxoSmithKline. Now, admittedly, it's UK and not continental Europe, but let's just include all of them as being part of the EU. Glaxo focuses on respiratory therapies. If you think about emerging markets, the biggest increase in emerging markets besides growth is pollution. Okay? And pollution affects your ability to breathe in a very fundamental way and in a very chronic way. Well, Glaxo, being a developed market company, is going to be able to solve the problems of these patients because their respiratory therapies are very well suited to things like asthma and COPD, etc. The other thing is, smokers in the 70s, smoking has decreased of late, of course, but in the 70s and 60s, a lot of people smoked. Well, they have aged and now they're going to get significant lung disease. you have a company here that focuses on the therapeutic class, which is going to experience a growth in the incidence of disease, emerging markets as well as developed markets. We could buy the stock again on 10 times earnings and a 6% dividend yield. So yes, was there uncertainty? Would the drug be approved or not? Of course there was, but you were paid for that uncertainty. Now recently that drug got approved and the stock is up actually 30%. So this is how you can get the margin of safety. You can take advantage of uncertainty because you're paid to take it. On the other hand, sectors like the utility sector, the consumer staple sector in Europe, we think is completely overvalued, utterly overvalued. Because of this fear of uncertainty, people want the certainty of staples, the certainty of a utility. And I would argue that the risk of investing in those two sectors has never been higher. And that's all over the world, by the way, including the US.
And I will delve a little bit deeper
Sure.
here, because when I look at your portfolio in Europe, most of the exposure is in so-called core Europe markets,
Okay, yes.
not in the periphery.
That's fair.
So walk us through, from a contrarian mindset, one would assume that there would be more companies in your portfolio in the periphery of Europe. So what am I missing?
Well, first, I think the International Equity Mutual Fund, Ariel manages, is benchmarked to IFA, which is a developed market strategy. So I think that explains some of it. But in the global strategy, where we can go anywhere, you're right, we're still underrepresented in emerging markets, but by design. Again, the ideas are not competitive enough vis-a-vis. If I try to buy emerging market growth company in China or India or some such market, Brazil, pick. Even in Poland, Jeronimo Martins, there are all these companies that you can play the consumer. Well, I just gave you an example of GlaxoSmithKline, where I can play the growth of the incidence of disease that's happening in emerging markets. I mean, pollution is not something that I have to imagine. It's here and now. And I can get it for a valuation that is so compelling. It just happens to be headquartered in a developed market and not in an emerging market. So our job is to figure out what is the best vehicle, what is the best approach to taking advantage of what's happening in emerging markets. And the approach is twofold. Either you can go direct or you can go indirect. At this point in time, the indirect vicarious exposure is more risk-adjusted returns than going direct. That's why we don't own those names. But as you noticed, we do the research on those names. I can tell you how many names we've rejected in emerging markets. That's why you don't see them in the portfolios. But that shows up, in our research, not in the outcome.
And what about Japan? It's something that you talked about earlier in the example of Toyota. Now that everybody is looking at Japan, or at least more people are looking at Japan than just 6 months ago or a year ago, tell us a bit about, with your experience in Japan, and having been there, having had that patience, and now seeing that others are validating a lot of that patience, what is sort of while others are catching up, what are you looking at in Japan? What is really on your mind now?
We're always looking for investment opportunities in Japan or elsewhere. But what's on my mind is one thing that people have still not understood about the change in Japan is not just the currency, which clearly everybody sees. It's the change in corporate governance. I was in Japan last year, as I go frequently enough, and I was struck by the first time in many, many years that I've been going there, where companies talked about how they want to think about how do you return some of the money that they've made in the business to shareholders. So there's a significant increase in dividend payouts. Japanese companies engaged in share buybacks, which is terrific because when your shares are undervalued and you engage in that, you create even more value for investors. So this was a message that I had not heard of before. So I think even in the consciousness of the Japanese management teams, there is a realization that there are different ways to create value, and not all of it is by increasing revenues or increasing competitiveness, both of which are nice to have and absolutely they are focused on it. In addition to that, there are more levers that you can pull because you have a strong balance sheet. You can actually return cash to shareholders. So the final piece of the puzzle is falling into place in Japan, which I think is still the unspoken story of the Japanese investment theme. But I would submit to you that some of the easy money, if I can call it such, nothing is ever easy, but has been made in Japan. And we are finding more opportunity in certain sectors in the US, for example. So we haven't talked about, here at home, since you're interviewing me in New York, the tech sector in the US has become pretty decimated, and it's thrown up a lot of opportunities. A decade ago, I owned practically no tech company in my portfolio because there was a TMT bubble and, stocks were very overvalued. But a decade later, people have given up on some franchises in the technology sector. Why? Because there is more uncertainty. But the uncertainty premium has never been greater, and the certainty premium has never been greater. So again, in the US, people own utilities, consumer staples, from Coke to Procter & Gamble, and we would argue those are overvalued investment opportunities. On the tech sector, where there's a lot more change, there's a lot more uncertainty, but the stocks are at a huge discount, and you're priced for that. So Cisco, Microsoft, Broadcom, these are many investments that we own in our portfolios. We think the US is also ripe for that kind of investment opportunity, even though the S&P 500 has gone up a lot. So I think in any market, you'll always find either sectors or portions of the market. The overarching theme, I would say, where we are finding the best sort of investment opportunities of late is this premium towards certainty, and this discount, I would argue deep discount towards uncertainty, is creating a value opportunity for investors like myself. And the two biggest areas is technology and healthcare.
And we'll get to that global mindset in just a minute. I do want to pick up on something in Japan that I thought was interesting, how you talked about what's underappreciated in Japan. And certainly from the discussions I've had in Japan, some thoughtful people have said that actually, well, it's easy to criticize Japanese companies for having lots of cash and strong balance sheets, but in a way it was a perhaps rational decision in the context of deflation.
Absolutely.
And if that deflationary environment is now perhaps changing, it stands to reason that there could be this huge mindset change in Japanese management, where actually these balance sheets become a return of capital to shareholders, which on that basis, Japan looks very cheap still, certainly individual companies that we're all foremost concerned about.
That's right. I think we kind of generalize when we call Japan Inc. Not everybody has changed, but we are stock pickers, so we just need a handful to change, and we can own those handful. But that's true of America as much as it of Japan. There are many, as I said, I would reject in America. There are many I would reject in Japan. I think the key distinction is not so much the deflation-inflation, because that came later. Last year, nobody was talking about this new Abenomics. He wasn't even elected. So I think that's a more recent phenomenon that can act as a catalyst in that direction. But I think the motivation to move down this path of figuring out, our obligations are not just towards our customers and our employees, but also towards our shareholders, has been going on, I would say, for the last 5 or 6 years. It's just been underappreciated because people chose not to ask that question. They assumed that Japanese corporate governance was always biased towards the first two constituents. And as I told you before, we believe in asking the right questions. When we asked, we found out.
And I want to come back to that global mindset, which really comes across in pretty much everything you say, and being opportunistic, contrarian, looking for the mispricings. How do you actually develop that mindset, and how perhaps here at Ariel, in your team, in your global equity team, how do you foster that culture where you can be opportunistic?
Well, I think it starts with our understanding, and this is something that's helped me a lot, is we try to understand which are the businesses that have succeeded and why did they succeed, how did they succeed. And one of the things we find is that almost all businesses that succeed for a long period of time, not for a short but a long period of time, are the ones who put their clients first. So I would say that what we do is we tell ourselves, what is it that the client wants? Put that customer first. And we understand that clients want 3 things from their investment portfolio. One is superior absolute returns. you need to compound your money, whether it's a retirement liability or some other liability that you need to meet. That's what you're saving for. So the money has to compound. It has to be about absolute returns. And I got that in my DNA from working at Soros and being part of the long short side. I think the long only managers sometimes forget that. They think it's only a relative game versus the benchmark. So if the benchmark's down 10 and I'm down 8, I've delivered some value. And frankly, for the investor who needs the money from 10 to grow to 12, it's false comfort. So absolute returns. Second, it is relative returns because there is an asset allocation. If you are benchmarking me against the MSCI ACWI or IFA, I need to outperform that benchmark because that's what your objective was in giving me that sleeve of your money. And the third thing investors want, besides absolute and relative returns, is lower risk. Our investment process recognized this, I would say, 20 years ago. So when I sort of came up with this investment style, discipline, philosophy, process, call it what you want, I put those three things front and center and said, let's custom design an investment process to deliver on those three things. And I'm fortunate that in my past career I have, and I look forward to doing it again in the future. But I would say that if you don't think about what you want to accomplish, and you don't sort of engineer a process to deliver on that, you're going to fail. It takes a lot of preparatory work. So I would say that's what helps us achieve this notion of risk-adjusted returns, because we put them front and center as the source of what we need to design into the process. Then, of course, it's about implementation. I often joke with my team that I am not a portfolio manager, although that's sort of my technical title. I'm a process manager, because if you implement this investment process, the results are going to follow. The portfolio gets constructed almost by itself, because I believe I need to manage my portfolio, my investments, by a series of principles. Once you manage to those principles, the outcomes follow. And perhaps it's a little bit like how I lead life. I've never set a goal in my life that I want to become a millionaire, or, it sort of falls into place that you're going to be successful if you understand what it takes to succeed, then you work on it. So it's a process. As a process manager, what I enforce with the team, and the reason why we're able to take advantage of these opportunities, is I told you three things. Figure out the business model, figure out the financial model, figure out the valuation model. And I know it sounds simple, but it's extremely hard to do. And then I think to have this mindset when you recruit the person themselves, right? It starts from the hiring process. They have to believe in this way of investing. It can't be taught. As I keep telling you, it's a craft. It has to be learned. So I think the people on my team come with different backgrounds and experiences, but we all believe in the same thing, which is this is the right way to invest. And we want not just superior returns, but superior risk-adjusted returns. And it causes a reset in the way you think about investing, because the moment you introduce a notion of risk, you introduce a notion of checks and balances. And that's what allows us to kind of, make this as a repeatable investment process, because the fewer mistakes you make, the better your performance record becomes over the long run, and the more reinforcing it is, and then it becomes a virtuous cycle. So I don't know if I've sort of helped you understand, how the team, how the culture is developed, but I think it's about living it and practicing it. And if I can bring to them a process, a structure that allows them to implement it on a day-to-day basis, then I've done my job well.
And you have, and recognizing the importance of that process, but at the same time that investing is a craft.
It is a craft.
I'd be curious to hear how you have developed over the years, and when you look back at your career, if you could share just with us how you have improved your process over time, and perhaps learned from some of the mistakes along the way.
So the very first thing I learned is actually from Silicon Valley. And I must confess, my biggest learnings and what's made me a better investor has not come from people who are investors themselves, but from people who are absolutely not investors. Because I think the danger of learning from others is you get to know something, but it's knowing something is not the same as applying it. When you learn from someone who's outside of your industry, well, you have to figure out how to apply it, because whatever they've told you does not have direct bearing, but has indirect bearing. So I'll give you something I read in the early 2000s, like 99, 2000, this TMT sort of euphoria that was going on. And a lot of people said, what a colossal waste of money, all this money that was in internet startups, and so many of them failed. But I think one of the lessons I learned from, and this was Meg Whitman, when she was running eBay, she said that the risk because she ran a very successful internet startup, right? I mean, eBay became successful very early on compared to many others out there. And she said, it's not that we don't make mistakes at eBay. It is that we keep the cost of those mistakes low. And what she was talking about is we experimented with a lot of ideas, with a lot of concepts, many of which failed. But as long as you keep the cost of that experimentation low, well, you can make a lot of mistakes. You can conduct a lot of experiments. That's how, and I looked at that and I said, wow, in the internet startup world, they're dealing with a lot of uncertainty. They don't know what's going to work. That helped me understand, okay, I can apply what she said there to what I do. And I always ask myself, how does it fit? And the way it fits is we ask ourselves that question, so what if we get this investment idea wrong? What if we are wrong, right? Let's say this is just an experiment. We think it's research, but we could be completely wrong. How much will that mistake cost us? So I will tell you that we have made so many investment mistakes. But the reason why we still, and I've had a good long-term track record in my career, is because I kept the cost of those mistakes low. This is why risk management, understanding what can go wrong and how much can the stock fall, what is my downside risk, I sort of learned it from a completely different area, but I applied it in this specific way. Another thing that has helped me become a better investor is, I think, as a young person, when you're young, everything is about doing things with the spirit of, I'm all in, right? I mean, you're all in. If you're passionate, you're all in. It's all or nothing. And I think from an investment standpoint, this analogy of a marathon versus a sprint, a very wise person in my life told me that think about investing as the Le Mans. It's an endurance test. So pace yourself. And so this notion of going all in, when you like something, even if I like Toyota a lot or whatever, go and put your full money to work there, right? Have a very concentrated portfolio. I don't believe in that anymore, because I think that there is uncertainty about how much a stock can fall. And there could be many reasons why the stock keeps falling. But if I don't keep powder dry, if I've gone all in my initial position, well, then I can't average down. So now, this is another lesson that, I've learned is that it's important to go in stages. So it's not about going all in. You feel very great about yourself. It's a very macho decision, if I may say, but it's not necessarily the right one. So by going in phases like a marathon, you're pacing yourself. You can actually accumulate and dollar cost average down so that when the stock goes down, you're not panicking. You're not wondering, oh, did I get my research right or wrong? You're simply averaging down and taking advantage of that, again, short-term volatility. Those two things, I think, are the most instrumental in the way I have learned from others. And I suggest to people that if they want to really learn from the mistakes that others have made, not necessarily in your own profession, but in others. And I've learned more from failure than I have from success.
And if I can call it this emotional detachment in a way to your portfolio companies, if you will, brings us back again to that edge in investing, one of the important edges, which is that behavioral edge. When others are panicking, you are not. Mm-hmm. Now that's again easier said than done. So there are a lot of these elusive concepts here, like patience, like being contrarian. I'm curious, and recognizing that investing cannot be taught, what resources perhaps or any practical advice you have for people who are starting out in the business or even people who have been investing but have not gotten perhaps the results that they wanted. What advice can you give to those people?
I think that they should try to be, even though I said that it's about insights and not about information, for someone who's starting out, they should try to absorb a lot of information, because you do need to have an antenna. Insights are developed when you connect the information, when you process the information, when you interpret the information. So that will come with experience and acumen and know-how, but it does not obviate the need for collecting that information. So it's not easy. So I think they should read and learn from someone who's been in the profession for as up close and personal as they can. So the first thing they should do is try to find a job with someone who actually has a great long-term investment track record. because you learn from others. That's why it's like osmosis. You see people, how they process information, how they interpret it, and it gets into your DNA and your consciousness. It's almost subliminal. And you will form your own rhythm and your own you'll apply, that know-how and knowledge in your own way, because this is very creative exercise. But at least you will have learned from someone, so that it will speed up your process of creativity, as I like to think about it, as opposed to constrain it. So I'm quite blessed. The people that I work with at Ariel, they think like we do. They're independent thinkers. And so we can challenge each other, we can brainstorm with each other, we can debate with each other. And that's what makes us better, that we can indulge in that kind of conversation. You talked about, how do we take the emotion out of the investing, which I think is spot on, because that psychological component of this investment sport is very much almost like half the battle won. When we are doing research on a company, I told you the two things. Don't do research on companies that you intend to invest in. I know it sounds so counterintuitive. Do research on companies that you don't intend to invest in. Find out what you don't like about it. Find out what makes it a bad investment. Why is it a failure? That will teach you more than when you do look at that investment that you think looks attractive. The pattern of failure that you have picked up on, that, oh, this is what went wrong, this is what went wrong. I'll give you a perfect example. Sony used to be the apple of Japan. If you just go back in time, Sony was the apple of Japan. Remember the Walkman, the Discman? Well, now we have, the iPod and the iPad, but just about a decade ago, that was a cool product to carry around. So knowing that, being informed about what happened to Sony and how much it has fallen from grace will give you a flashpoint that, gee, could this happen to Apple? That alone takes the emotion out of the investment. Because when you've seen that failure of a Sony over this decade, and you've seen that that can happen to something that was viewed to be a blue chip, it'll force you to ask that question. Imagine if you are, looking at a person and you say, gee, these are all the things that I like about this person. When you interview a person, then you also have to ask the question, gee, what I don't like about this person. And it's when you make that calibrated, you force yourself to ask that other question. And I think it's all about, the more you're informed about the investment, the good, the bad, and the ugly, the less the emotion there will be in it.
Well, on that note, Rupal, I really want to thank you so much for sharing your insights with our audience. I certainly learned a lot from this, and can appreciate a lot of the points that you made, such as being opportunistic, having the patience, being contrarian, a lot of elusive concepts here, perhaps difficult to grasp, but thank you so much for sharing the insights to help us understand them better.
Well, thank you for the opportunity. It's not often that one gets a chance to voice one's views in a more substantive format like yours. So congratulations to you. I've seen the other videos that you have done, and I must confess it's very impressive, because this is a topic that requires more exposition than can be captured in a soundbite. So thank you for giving me the amount of time that you did, and I wish your investors well.